Two investors both made 20% last year. The first held a portfolio that drifted steadily upward, a calm, almost boring ride to a good result. The second's portfolio swung 40% up and 30% down before eventually landing at plus 20%. Is that the same outcome? The return is identical. But clearly something important is different. That something has a name. That something is volatility, the standard deviation of returns. Take your daily returns over some period: Monday up 1.2%, Tuesday down 0.8%, Wednesday up 2.1%, and so on. Compute the average return. Then for each day, measure how far that day's return strays from the average. Square those distances, average the squares, then take the square root. That number is the standard deviation, and in finance, it is what we call volatility. A high volatility means the returns are widely scattered around their average. A low volatility means they huddle close to it. It says nothing about whether the average is positive or negative. This is the most important thing to get right about volatility, because intuition often gets it wrong. Volatility is not the same as risk of loss. A stock that goes up 3%, up 4%, up 3%, up 5%, always up, has low volatility. A stock that swings plus 6%, minus 4%, plus 7%, minus 5% has high volatility even if the net result is also positive. Volatility measures uncertainty, the width of the distribution of outcomes, not the direction. High volatility means the return surprises you, day after day. It does not tell you which way. Daily volatility is useful, but the number practitioners quote is annualized volatility. The conversion uses a rule worth understanding: annualized volatility equals daily volatility multiplied by the square root of 252, the number of trading days in a year. Here is why. If daily returns are approximately independent of each other, variances add. 2 independent days of variance contribute twice the variance of one day. 52 weeks of 5 trading days each contribute 252 times the daily variance. To go from variance to standard deviation, you take the square root, so the scaling factor is root 252, not 252. That is the square root of time rule. A stock with 1% daily volatility has an annualized volatility of roughly 16%. A stock with 2% daily volatility has an annualized volatility of roughly 32%. The daily number sounds small. The annualized number tells you what you actually face over a year. Back to our two investors. The smooth portfolio had a daily standard deviation of about 0.6%. Multiply by root 252 and you get roughly 9.5% annualized volatility. The wild portfolio had a daily standard deviation of about 3%. Multiply by root 252 and you get roughly 48%. Same 20% return. But one investor was exposed to less than 1/10 the variance of the other to earn it. If you had to allocate your savings to one of these two portfolios without knowing which would perform better next year, volatility is exactly the number that captures what you are choosing between. Return tells you what you got. Volatility tells you what you went through to get it. There is one more property of real market volatility that every practitioner knows and that the standard deviation formula alone does not tell you: volatility clusters. Look at any long history of daily returns, equity indices, currencies, commodities, and you will see the same pattern. Calm periods last for weeks or months. Then something shifts, and turbulent periods arrive in bursts. Big moves follow big moves. The 2008 crisis did not produce one bad day and then calm. It produced weeks of outsized moves. The implication is that volatility is not constant, it has its own dynamics. Yesterday's volatility is informative about today's. This is the motivation behind a class of models called ARCH and GRCH, autoregressive conditional heteroskedasticity, which model the time-varying nature of volatility. You do not need to know the formula yet. The intuition is, the market's nervousness is autocorrelated, and ignoring that leads to badly missized risk estimates. The square root of time rule rests on one key assumption, that daily returns are independent of each other. In practice, they are not perfectly independent. There is mild serial correlation, and in turbulent periods, the correlation is stronger. This means annualized volatility computed as daily vol times root 252 is an approximation, not an exact result. It also means that a single volatility number for a strategy is a snapshot, not a constant, because if volatility clusters, the number you computed last month may be very different from the number that applies right now. When practitioners say a strategy has 15% annualized volatility, they usually mean a historical estimate over some look-back window. That estimate is always stale. And for heavy-tailed return distributions, which financial returns often are, the standard deviation captures spread but not the magnitude of the worst outcomes. So now we have two numbers for any strategy or asset, the average return and the volatility. The investor who made 20% with 48% vol and the investor who made 20% with 9.5% vol earned the same return, but one of them was taking on 5 times more uncertainty to do it. If you had to compare those two outcomes in a single number, what would that number look like? That question is exactly what the Sharpe ratio was designed to answer. Thanks for watching. You now know that volatility is the spread of returns, not the direction, and why quants annualize it with root 252. The next step is to combine return and volatility into a single score. Episode 3 builds the Sharpe ratio from scratch. See you there.